Futures and options, F&O trading, involves derivative contracts based on underlying assets like stocks, commodities, currencies, or indices. These instruments allow traders to hedge risks, speculate on price movements, or leverage their positions with less initial capital compared to outright asset purchases. Futures contracts are agreements to buy or sell an asset at a predetermined price on a specific future date. Both parties are obligated to honor the contract. Futures are standardized and traded on exchanges, requiring margin deposits for risk management. Traders often use them for hedging, protecting against price fluctuations, or speculation, betting on price movements. Options. Contracts grant the buyer the right, but not the obligation, to buy, call option, or sell, put option, the underlying asset at a fixed price, strike price, before or on a specific date. Expiry. The buyer pays a premium to the seller, writer, for this privilege. Options are versatile tools used for hedging, directional trading, or strategies like spreads, straddles, and strangles. In advanced trading, F&O strategies involve combining multiple contracts to manage risk and maximize returns. For example, hedging, protecting portfolio value by offsetting potential losses. Speculation, taking calculated risks based on market trends. Spread strategies, combining contracts with different strike prices or expiries to profit from volatility or price direction. While F&O trading offers high potential returns, it carries significant risks, including the possibility of losing more than the initial investment in leveraged positions. It requires a deep understanding of market dynamics, contract specifications, and robust risk management practices. An option chain is a listing of all available options contracts for a particular underlying asset, typically displayed on a trading platform or exchange. It includes data for both call options and put options at various strike prices and expiration dates. The option chain helps traders assess market sentiment and make informed decisions by providing information on option prices, premium, open interest, volume, and implied volatility. Call option. A call option gives the holder the right, but not the obligation, to buy the underlying asset, such as stock, index, etc., at a specified price, the strike price, before or on the expiration date. Investors buy call options when they expect the price of the underlying asset to rise. For example, if a stock is trading at $100 and you buy a call option with a strike price of $110, you can buy the stock at $110 even if its market price rises to $120. Put option. A put option gives the holder the right, but not the obligation, to sell the underlying asset at a specified strike price before or on the expiration date. Investors buy put options when they expect the price of the underlying asset to fall. For instance, if a stock is trading at $100 and you buy a put option with a strike price of $90, you can sell the stock at $90, even if the market price falls to $80. Key elements in an option chain. 1. Strike price, the predetermined price at which the option holder can buy, call, or sell, put, the underlying asset. 2. Expiration. Date, the date by which the option must be exercised or it will expire worthless. 3. Premium, the price paid for the option contract. This is the amount the buyer pays to the seller for the right granted by the option. 4. Open interest, the total number of outstanding options contracts, both calls and puts, that have not been settled. 5. Volume, the number of contracts traded within a particular time frame. 6. Implied volatility, IV, a measure of the market's expectation of how volatile the underlying asset will be in the future. Higher IV generally means higher option premiums. Call versus put example. Call option. If you buy a call option with a strike price of $100 on stock A and stock A rises to $120, you can buy it at $100, a profit of $20 per share. Put option. If you buy a put option with a strike price of $100 on stock A and stock A falls to $80, you can sell it at $100, a profit of $20 per share. Traders use these instruments for speculation, hedging, or leveraging positions, but options trading can be complex and carries high risks, especially when using strategies like selling options, writing,